to Trade Africa, ladies and gentlemen. I am Samuel Ngon. Today, we're going to talk about the first part of market indices, its definition and its particularity. And we will also emphasize how we can use the index when we are getting in and out of trade. Now, if we ask you, what is market indices? What will be your response? Let's first dive in the word indices. According to the definition, indices can mean an indicator, sign, signal, or measure of something. So, what is market indices then? Market indices represent the entire market's overall changes, measuring the value of the selected group of stocks. In other words, it can simply represent the performance of certain groups of stocks, serving as indicator for traders or investors. In this section, we're going to be covering four main indices in the US stock market. The first one is the Dow Jones Industrial Average. The second one is the NASDAQ. The third one is the Standard & Poor's 500. The fourth one we're going to talk about is the SVSY, or the Fear Index. Let's start with the Dow Jones Industrial Average. The Dow Jones Industrial Average, also called the Dow, is an ETF and its track symbol is GJI. This is a chart of the Dow Jones Industrial Average here on the screen. Here we have the daily chart. One candle here represents 1 day of trading. Here we have the weekly chart. One full candle here represents 1 week of trading. Here we have our monthly chart. So, one full candle here represents 1 month of trading. Back to our course. What is the Dow Jones Industrial Average? The Dow was found on February 16, 1885 and developed by the Dow Jones and Companies. The Dow is the most veteran and foremost index on the Wall Street. Large numbers of investors worldwide view the Dow as the main tool for following US markets mood. It is the index that is mostly mentioned when people talk about the stock exchange. This is what most of the media talks about when they want to talk about finance or economy. They always say Dow Jones Industrial Average was up or down 100 points today. Most people don't even know what it is. It's made up of 30 stocks, 30 of the biggest blue chip companies like Caterpillars, IBMs, Deere's, Home Depot, Goldman Sachs, and many others. As we said previously, the Dow is tracked as ETF and its symbol is GJI. But how important it is for us as day traders put a line through it. We should care less about the Dow Jones Industrial Average. Why? Because it only has 30 stocks in it. It's not giving us a big enough view of what the overall market is doing. However, what must we consider as a day trader? Let's check the second index. The second one is NASDAQ. What is NASDAQ index? Well, the NASDAQ stands for National Association of Security Dealer Automatic Quotation System. It's the largest electronic trading stock exchange in the US and is comprised of the leading 100 NASDAQ companies, usually made up from tech companies like Apple, Google, Microsoft, Tesla, Amazon, and more. The NASDAQ is also tracked as market ETF, and that symbol is the QQQ. So we must often refer to this when we are trading as an indicator to place our trade. Let's take a look at the QQQ chart on the screen. QQQ. Ladies and gentlemen, this is the QQQ chart. Here we have a daily chart of QQQ. One full candle here is 1 day of trade. And here is a weekly chart of the QQQ, the NASDAQ. So one full candle from here to here is 1 week of trading. Ladies and gentlemen, this is the monthly chart. It means that one full candle here represents 30 days of trading. Back to our course. As we said, the QQQ is the tracking symbol for the NASDAQ. It's another barometer that we use as traders as we are trading tech stocks on the day-to-day basis. The market predictor, the QQQ, is really more volatile than the other index and more important for day traders than the Dow Jones Industrial Average will be, because it got 100 technology stocks that are heavily loaded on the triple Q. Ladies and gentlemen, let's recap what we got so far. We heard that even though the Dow Jones Industrial Average is the most veteran or famous on the Wall Street, as day traders, we should care less about it. Why? Because it only has 30 stocks on it. Instead, the market predictor, the QQQ, which is more volatile than all other index, is more important for day traders than the Dow Jones Industrial Average. Why? Because it got 100 technology stock loaded on the triple Q. In our next lesson, we will talk about the remaining two indices, the SPY, the SVSY, and their importance. We invite you to take advantage of these free courses because others pay a fortune elsewhere to get the same thing. But here at Trade Africa, you have them free of charge, and it's a big privilege as promised. Let's meet next week for the second part of this chapter. Thank you for your time, and bye.